Many of us were taken aback when Cathie Wood's ARK Investment Management unexpectedly made an investment in General Motors. Given Wood's recent troubles and his shifting perspective on GM, the outcome of Wood's new stance on GM will undoubtedly have a significant influence on the industry's view for years to come. In this video, we'll examine the significance of Wood's prediction, its implications for the larger car industry, and the context of Tesla's recent price reductions. But hit that subscribe and like buttons before we move on. Remember to use that notification bell as well. According to Wood, by 2025, Tesla's shares might reach an incredible $3,000. This forecast, which is rather astounding, sheds light on the difficulties that established automakers like GM and Ford may encounter in the years to come as they attempt to compete with startups and more creative businesses. This forecast stands in sharp contrast to some analysts' more optimistic assessments, such Morningstar's David Witston, who believes that GM stock has a fair value of $68. Jim Farley, the CEO of Ford, acknowledged that the business had lagged behind in its adoption of electric vehicles in a recent interview with Sandy Munro. Farley declared his intention to build an affordable automobile for everyone in order to win the world. And pay homage to Henry Ford's accomplishments, Farley stated that it's critical to understand that success in China, where digital EV products are becoming more popular, will depend on providing a range of products, not just high-end ones. During the 1970s, Farley saw GM's market share plummet from 60% to almost nothing, while Toyota, who had no market share before, rose to the top by manufacturing automobiles that consumers desired. Thus, Farley believes that the winning approach is to take the market as a whole rather than just a segment of it into account. Ford, on the other hand, thought it could compete in the European market for sedans and hatchbacks, but after experiencing difficulties there, it realized its true strength is in the pickup truck sector. With Maverick, they concentrate on markets where they have a deep understanding of the consumer to make sure their innovations are accepted. Farley acknowledged that with just 6.2% of the EV market share, Ford is now in second place, right behind Tesla. He did, however, note that Ford should be pleased with their 95 electric advancements. In an unexpected development, Wood's ARK Invest Management has acquired more than 150,000 shares of General Motors for its autonomous technology and robotics fund, despite the fact that some people may not think Farley and Ford real. ARKQ, you may be familiar with ARKQ if you've been trading or investing, but what exactly is it? Exchange-traded fund ETF ARKQ is actively managed by renowned disruptive innovation-focused investment management company ARK Invest. The ETF's goal is to give investors exposure to the rapidly expanding robotics and autonomous technology markets. It makes investments in businesses that work on developing, manufacturing, and distributing robotics, automation, and driverless car technologies. ARKQ anticipates that the businesses it invests in will profit from the rising demand for autonomous technology, which encompasses robots, drones, and self-driving cars. Transportation, logistics, manufacturing, and healthcare are just a few of the areas that these technologies have the potential to transform. Top-down and bottom-up research are the foundations of ARKQ's investment strategy. The macroeconomic and technological factors that are anticipated to have a significant impact on the autonomous technology and robotics markets in the future are thoroughly investigated by the fund's managers. In-depth company-specific research is also carried out by them to find the best investment prospects in these markets. ARKQ is renowned for its high-conviction investment strategy, which indicates that the managers of the fund are prepared to take large positions in businesses they think have promising futures. This offers the possibility of enormous gains, but also a significant degree of performance volatility for the fund. All things considered, ARKQ presents a special chance for investors to participate in the developing fields of robotics and autonomous technology. With its emphasis on disruptive innovation and conviction-driven investing, the ETF may be a compelling choice for investors looking to gain exposure to this quickly expanding market. This investment is noteworthy because it demonstrates that even rapidly expanding technology firms like ARK are acknowledging the potential of established manufacturers and the ways in which the auto industry is evolving. Additionally, it draws attention to GM's initiatives in driverless technology and electric vehicles, which are being noticed and may eventually pay off. ARK's decision is encouraging for the auto industry as a whole because it shows that established automakers can change with the times and still be competitive, particularly in markets for autonomous and electric cars. It also demonstrates the possibility of cooperation between more recent, cutting-edge businesses like Tesla and established automakers. When making investment selections, investors should be open-minded and take a variety of things into account as the auto industry continues to change. Recent price reductions from Tesla present a challenge for rival automakers trying to stay competitive rather than a danger to the brand. Wood claims that Tesla's cost leadership and battery technology are to blame for these price reductions, and that other manufacturers must adopt this technology in order to stay profitable and competitive. Lowering prices is a calculated move by Tesla that may pay out for the business in the long run. Tesla can boost sales volume and achieve higher economies of scale by lowering prices in order to draw in more customers and increase its. This might strengthen Tesla's competitive edge and make it harder for rival automakers to overtake it. The introduction of the Model 3 is one instance of how Tesla has effectively used lower prices to obtain a competitive advantage. With a starting price that was far lower than that of its predecessors, Tesla made the Model 3 more affordable for a larger group of buyers. Additionally, it made it possible for Tesla to draw in a sizable number of Model 3 pre-orders, which aided in the company's rise to prominence in the electric vehicle industry. The decision made by Tesla to lower the price of the Model S earlier this year is another example of how the corporation uses pricing as a strategic tool. Concerns were expressed by some analysts that Tesla's profit margins and brand value may suffer over time as a result of this price cut. Supporters of Tesla countered that the business could maintain profits while cutting prices due to economies of scale and cost leadership. The reduced costs might also allow Tesla to increase its market share and carry on with its innovative work in the electric vehicle industry. Due to its increased manufacturing volume, Tesla is able to allocate more funds into research and development, thereby strengthening its competitive edge and impeding the efforts of other manufacturers to catch up. Some Wall Street experts, however, have a different take on Tesla's recent price reductions, believing that they could harm the company's profit margins and eventually damage the company's brand value. Lower pricing have the potential to undermine the luxury and exclusivity that have been the cornerstones of Tesla's brand. Critics also point out that rising supply chain and battery manufacturing costs may limit Tesla's capacity to keep cutting prices. Supporters of Tesla contend that the business will be able to maintain its profits while lowering prices because to its cost leadership, advancements in battery technology, and economies of scale. Additionally, they think that by lowering prices, the business will be able to increase its market share and carry on innovating in the EV industry. One reason Cathie Wood believes legacy manufacturers are in jeopardy is that they have been sluggish to adopt new technologies, especially electric vehicles. Tesla has made significant investments in EV technology and produced excellent, reasonably priced electric vehicles that have grown in favor among customers. On the other hand, a lot of established manufacturers have been reluctant to make EV investments and have kept their attention on gas-powered vehicles, which has put them at a disadvantage in the quickly changing automotive market. Because the automotive sector is so complicated and capital-intensive new technologies are adopted slowly, it can be challenging and costly for legacy automakers to adapt their business model to include new technologies because they have established ties with suppliers and dealerships. They might also be hesitant to purchase EVs because of worries about the high cost of battery technology and the dearth of infrastructure for charging EVs. But as the market for electric vehicles EVs expands, traditional automakers are beginning to make larger investments in the technology. Several have declared that they will phase out gas-powered vehicles and introduce new electric ones in the upcoming years. Even if they might still need to catch up on innovation, legacy automakers are starting to understand how crucial it is to adopt new technology in order to remain competitive in the market. Rivian, Lucid Motors, Tesla, and other new entrants are upending the established auto industry and forcing established manufacturers to change with the times. Legacy automakers must contend with new competitors as well as regulatory obstacles. Stricter emissions laws are being implemented by governments all around the world, which will make it more challenging for automakers to keep making gas-powered vehicles. Further money for electric vehicles is being demanded by regulators, which will put further pressure on established automakers that have been sluggish to adapt. Legacy automakers will need to make significant investments in new technology and modify their business plans to satisfy regulatory and customer demands in order to remain competitive in this rapidly changing market. The production process, marketing plans, and supply chain may all need to be significantly altered in order to achieve this. We appreciate you viewing our video. We hope it was enjoyable to you. Please rate it and remember to subscribe to our channel.